The first is, maybe you're at the stage of whether to consider to incorporate or not. And the thing is, there's a lot of bad advice floating out there where it's always the good way to incorporate. It's always a good choice, but that's not the case.
Hey, this is Thomas. Are you a Canadian sole proprietor or business entrepreneur to save more taxes? Well, today's episode with Connect with Thomas, I get to invite Gabrielle Chung from Balance and Wealth CPA to share more how taxes works. So be sure to find out more. Hey, Gabrielle, thanks for being on the show.
Thanks for inviting me. Excited to be here.
Awesome. So today our topic is about how taxes works, right? But before I do that, can I trouble you to just quickly introduce yourself?
Yeah, of course. So I'm Gabrielle. I am also a finance YouTuber. I go by Gabrielle Talks Money. And my background is actually as a CPA, a chartered professional accountant. And I also have a CPA firm called Balance and Wealth CPA, where we help out small business owners in Canada with their taxes and their accounting. So I'm happy to be here and answer any questions that Thomas has about helping small businesses.
So I know you have a lot of experience in the accounting industry. I know you've been working at a big four firm for at least 7 years, and now you have your own practice and you have a great YouTube channel as well too, right? So I guess my first question will be, as a tax expert, what do you see the trending in the last 10 years? Is it more easier for accounting? Is it more complicated for accounting?
So great question. I think you could kind of see it in two ways. There is, if you are a salaried employee, it's pretty straightforward. You get your T4, you report it on your personal tax return, and there's not much you can do. So mostly maybe your RRSP deductions, right. So your registered retirement savings plan, or charitable donations, but that's pretty much all you can do. But in this current market where the gig economy is starting to grow and there's a lot of people having side hustles, it's becoming a little bit more complicated, but there is definitely a lot more tax planning opportunities. So for example, if you just started out your business, you might be a sole proprietor. So in the eyes of the CRA, you and the business is considered the same. So you report it on your tax return, but the bonus is you're a business owner now, so you could take a lot more tax deductions. So for example, if you rent or if you own your home, then you could actually deduct a portion of that as a home office expense, which is something you might not have been able to do as an employee. Or if you have a car, you could even deduct part of the car expense as a business owner. So there's a lot more opportunities there. But I guess just to kind of give you a framework in terms of more tax planning opportunities as a business owner, since that's sort of the focus of today's video. The first is, maybe you're at the stage of whether to consider to incorporate or not. And the thing is, there's a lot of bad advice floating out there where it's always the good way to incorporate. It's always a good choice. But that's not the case, because you as an individual and you as a business, there's just so many things going on that you need to consider. And all that needs to be taken into account before you incorporate, or else it might be a costly mistake, or you might not reap the benefits of it. So that's the first thing, whether to incorporate or not. And that's a great opportunity if you're at that stage. Now, the second one is going to be bookkeeping. I know that bookkeeping doesn't sound all that fun, but it's so important, and it's not something that you should leave until the very last moment where you're trying to do your taxes. Because the whole point of bookkeeping is to understand how your business is doing and get insight into your profitability, how your income is, how your expenses are, so that you can actually make critical financial decisions when it comes to your business. So when it comes to scaling, when it comes to growing, what are your numbers? Can you sustain that growth and when you want to scale? So keeping on top of your bookkeeping is really important. Also, part of it is like keeping all your supporting documentation. So when it comes to like a CRA audit, you want to be prepared when it comes to that. So it's not just, doing your bookkeeping just for tax purposes. You want to do it for much more than that, to get insight into your business. Now, the last part is where the tax part comes in, the tax planning. Now, in this case, you might want to reach out to a tax advisor who has experience in helping businesses. But there is a lot more opportunities there. Like I said, what sort of expenses are tax deductible? That's one thing. But if you're incorporated, now you need to consider that the corporation and you as an individual are separate entities. So how are you going to be transferring funds from one to the other? One thing to consider as part of tax planning is, should you pay yourself a salary or a dividend? Another one to consider is, if you have a family member who is able to work in your business, is that, in that case, maybe you're able to employ your family member who's at a lower tax bracket, who you could pay a salary to and take advantage of a lower tax bracket compared to you. So there's a lot more things to consider, and we could get a lot more complex, but those are sort of the 3 steps to think about if you are a business owner, if you're just starting out, and you want to get your business finances under control.
Well, that's why we have you right here, right? So maybe I'll dive into a little bit more deeper into those 3 topics you talked about. So first off, you mentioned that, okay, if you have a side gig that you might consider yourself as a sole proprietor or a business owner. So is there like a rough estimate, a rough number that, hey, if you make this X amount, then we recommend you to look into the business way? Or if it's less than that, because at the end of the day, it's all about tax saving at the cost of hiring an accountant or doing the bookkeeping, right?
Exactly. So that's a really cool question. And a lot of business owners do ask me this, but I'm always really hesitant to give them a ballpark answer because there are a couple factors to consider. First of all, are you still working a 9 to 5 that can sustain your lifestyle? Because like I said, the corporation is separate from you. So the moment you take money out of the corporation, then more gets added into your personal income. But if you don't have a 9 to 5, then you need to be taking more money out of the company. That's one thing to consider. Another one is to consider how much money you're making as an individual and how much the corporation is making. So you might have other investment income sources that we might need to consider, and we need to also consider how much the corporation is making. So we have to take all those numbers into consideration. But if I were to give you a ballpark number, because I think that's what people want, maybe in the 50,000 to 100,000 range, maybe at that point, that's something to consider.
And is that on top of the personal income already? Or if like, hey, if your only full-time career is making $50,000 to $100,000 profit, then you should consider incorporated.
Yes. So the higher your personal income is, so let's say that you have a 9 to 5 or you have high investment income, which is great, then it's recommended to incorporate faster because you're already at a high marginal tax rate. But if your income is not that high, or you don't have any other sources of income, and your corporation or your business is your main source of income, then you'll be extracting more from the company. So there are going to be less advantages of the corporate tax rates. So the corporate tax rate here in BC is 11%, and then the marginal tax rate, the federal and the BC provincial rate combined, is 20 to 50%. But every time you take money out of the corporation, then that's less income that's taxed at the lower rate, and then more income that's taxed at your marginal tax rate, 20 to 53.5%. So a lot to consider there. So I suggest that if you're at this stage, to maybe reach out to a professional to get that quick calculation, and then you'll be able to make a better financial decision. Because I'm going to tell you, I've had a couple of clients come to me where they incorporated way too early, and it's just really expensive to maintain a corporation, right? There's just so many more compliance requirements. So it's really expensive. It wasn't worth it. And then other times where or businesses were incorporating way too late, and they paid so much more in taxes than they needed to. So that right timing is really important.
Awesome. Well, let me go into the second question you mentioned about bookkeeping right now. Obviously, I know that bookkeeping, having the documentation is really important, but what will be some of the tips, right? Because do you mean that, every time I go to a restaurant, every time do I go to a gas station, do I get the receipts and just leave it in my wallet for the next 1 year or so?
Right. So the thing that accountants hate the most is a shoebox of receipts.
Right.
So I'll give you a couple of tips around this. The first one is to do your bookkeeping on a more continuous basis. So don't do it once a year when it comes to tax return time, because when you try to reflect back and go through all your receipts, you won't remember what was what. So it's going to be really hard to do your bookkeeping. So if you could do it more on a monthly basis and get all your receipts out and you track all your expenses, that will be a lot easier than doing it once a year. So that's the first tip. The second tip is, how do I keep track of my receipts in a way that's easy? Right? So one thing is to take a picture of it. You could just use your phone to take a picture of it and then upload it to some sort of Google Drive or Dropbox, and you could actually sort them by folder. And this will be a lot easier if you do it once a month or every 2 weeks, right? If you sort it. So keeping a digital record is a great way to not deal with the shoebox issue. Another one is to use software like QuickBooks. So I like to use QuickBooks, and what I can do is open up the app, take a picture, and then it gets uploaded to my books. So that's also another easy way to keep track of your receipts, because you're required to keep it on file in case a CRA ever audits you.
And how long would that be?
For 6 years.
6 years.
Yeah, that's a recommended time.
Awesome. Well, then how about tax planning? So now, for example, okay, I have all these receipts, ready submitted to you for tax filing. So what are some ways that we should pay attention to? So for example, I always heard about, you can write off your cars, you can write off your home office, right? But I know that there's a certain limitation around that.
Yes. So for those cases, I could kind of give you, a general explanation of it. But like I said, I recommend that you go to a tax professional when are actually going down, when it actually comes to taking these deductions. But for home office, how it usually works is you will get a floor plan of your home, and then you take a percentage of an office space that you use exclusively for business. Otherwise, if you use it for personal as well, we need to do some sort of ratio calculation. But let's assume you use it 100% for business. Then you take that square percentage, you divide it by the total square percentage, and then you apply that to any sort of home expenses you have. So if you rent, pretty simple, just rent and maybe electricity bills. When it comes to owning a home, there's a benefit because you could deduct a lot more. Yeah. So your mortgage interest, so not the principal, just the mortgage interest, and then stuff like, and expenses like strata, your heat, your electricity, your property taxes, and you get a percentage of all of that. So, usually as an employee, you don't get any of the, most of the time you don't get any of those benefits, but as a business owner, you're able to take advantage of that. It's a personal asset that you could deduct for business purposes. For vehicle expenses, same concept. You need to take record of your mileage. And I know it could be a little bit tricky to keep record of your mileage all the time. Like I mentioned, there are apps out there where you could track the start and end of a trip for business. So that's really handy. Another is to first take a picture or record of the odometer at the beginning of the year, so January 1st, and then at the end of the year, December 31st, and see what that total kilometer driven is. So you take the business use out, you divide it by the total driven in the year. That's your business use percentage. And now you could apply that to all your vehicle related expenses, your fuel, your maintenance, your insurance, the cost of the car, the lease of the car. So anything that's related to the car, you could take a percentage of it. And this car could be your personal, that you can deduct a portion of it for business.
Wow, that sounds very complicated. I'm glad that I have you right here and I have all the apps in here as well too. And not sure if you know, that's a team right behind it. We're all self-employed, so then this is a perfect tips for them as well too, right?
Yeah,
as well
hopefully
too.
I'm explaining in a way that's easy for you guys to understand. But if you guys have any questions, I do have a free template actually for bookkeeping that small business owners can download to get you guys started. And then as things get more complicated, then you could feel free to reach out to a professional.
Sounds good. Now to my next point, which is the tax planning. Right now, okay, I collect all the information. As the tax experts, where do you see yourself that, hey, this is where you can actually save more taxes? For example, right, I always heard, should you pay yourself in salary? Should you pay yourself in dividends? Should you pay yourself in shareholder loans, or not pay yourself at all, right? Yeah. So usually, how would you advise your clients to take which routes? Right, okay, wow, we're really getting there. So this can get a little bit more complex, so I don't know how much we want to cover today, but if I were just to give you the gist of how it works, there's benefits to salary and benefits to dividend, and there are a couple of factors that you need to consider. So for salary, one of the benefits is that it increases your RRSP room because it's considered earned income. Whereas dividend, it doesn't increase your RRSP room, so you can't take that deduction on your personal tax return because you don't have any room to contribute. The disadvantage to salary is you have to deal with payroll tax. Yes. Payroll tax, there's just so much going on. If you're late, you get a hefty penalty. And so that's something that you need to be aware of, the compliance burden. But another benefit to salary is it's a deduction on the corporation end. Right. So you have your income, you take the deduction for salary, and then it reduces your net income for taxes. Right. So it's a deduction. Yeah. So it's like you're paying less in corporate taxes, but you're paying more in personal taxes, which sometimes could be actually a disadvantage.
Maybe it depends. So you need to do some calculations there. But why I say this is because for dividends, it comes out of after-tax profits of the corporation. So you have your net income from the corporation, and then you have to take out your dividend. And then the dividend gets taxed on the personal level. There is something called a dividend tax credit. So it takes into consideration the taxes that were paid on the corporate end. So, obviously you don't pay you don't get double tax. That is called integration in Canada. It means that, the amount that integration meaning that basically you don't get double tax. There's some sort of credit to make up for taxes that were paid on the corporate level. That being said, there are different ways you could calculate and different ways you could combine dividend salary where you could optimize and pay and minimize taxes versus just paying salary and just paying dividends. So that calculation is usually done by an accountant who knows your situation and knows what your financial needs are. Depends on how much the company has made, all that kind of stuff. So it really depends on the individual.
Awesome. So we covered the why are we going to incorporate, the benefits of incorporating, what are some tips about bookkeeping, and what are some tips about tax planning. So maybe I wrap it up with today with one final question will be like, we talk about in the last 10 years, okay, people actually from employment to now self-employed to more investment basis nowadays now. But where do you see yourself, or where do you see the clients trending in the next 10 years? For example, do you think that AI will be helping them, helping you, or is actually taking more opportunities away from us?
So I think we're kind of moving towards a trend of self-education. So like one thing that we noticed about COVID is, going back to the investment example, is that before a lot of the financial institutions took care of it, but now there are more, individual investors who are willing to learn and take care of their own money. I think something like that will happen for tax planning, where individuals will educate themselves about taxes, which I think is really important to know more about taxes because it's something that you have to deal with for the rest of your life. So why not get ahead and be at the forefront of understanding how your own taxes work. Now, that being said, there are professionals for a reason. So if aside from the basic understanding of your taxes and how it works, if you want to sort of take it to the next level and really minimize your taxes and save on taxes so that you could reinvest it back into your business and have more profits for you to keep, is to reach out to a professional who will be able to help you with that and to kind of navigate the complexities of it. Because unfortunately, as much as it's meant for the public, there are resources out there from the CRA where it's meant for the public to understand how it works, but at the same time, it's very complicated. I mean, the Income Tax Act is 3,200 pages thick. So I have a copy in my home. It's literally like that big. And it's impossible to understand every single concept in there. So I think your best bet is to reach out to someone who knows how it works. But at the same time, going back to my initial point, it's really important to self-educate and try to at least understand your tax situation and to know that you're doing the best you can so that you don't need to pay $1 more than you really have to.
And I believe that is the main reasons why you have your YouTube content as well too, right? So for those of you who don't know about it, there's actually a great YouTube channel in there. I'll list the link in the below as well too. And then thanks so much for having you been here.
Yeah, I mean, thanks so much for having me here today. And I had a fun time answering your questions. And I hope that business owners could get something out of our conversation today.
Awesome.